Hi there. I'd like to thank you for taking the time to watch this short presentation. My name is Gary Torrance, and in the next few slides, I'll try to highlight the risks associated with different types of syndicated mortgage investments. We all know that investments with higher risk yield higher returns, and accordingly, lower risk investments yield lower returns. When it comes to traditional investments, we associate equity funds and stocks to a higher risk and return than bonds and money market funds. In 2008, when markets weren't performing very well, investors began looking for alternatives. Due to the strong real estate market, one of the most popular alternatives was syndicate mortgages, specifically in the real estate development sector, which can be compared to equity funds in terms of risk and return. Until now, there hasn't really been an alternative to bonds in the syndicate mortgage market, which is why we are proud to be the first in Canada to offer syndicate mortgage investments in farmland operations. Now let's take a closer look at what these two types of syndicate mortgage investments pay for, what the risks are, and ultimately what the expected returns are. Let's first take a look at what your client's investment pays for in a real estate development syndicated mortgage. Well, the first thing that the developer must ensure is that they will be able to pay the investors their interest, and therefore they create what is known as an interest reserve. As an example, let's assume that the developer needs to raise $1 million on a 3-year project and will pay 10% per year, which amounts to $100,000 in interest per year. In this case, the developer must reserve $300,000 to ensure the interest payments are made. Additionally, the investment is used to pay for consultants and legal fees so that they can rezone the property, at which point a marketing and sales team will be put together to sell the proposed units in order for construction to begin. So what's the risk with this investment? Well, mainly it's time. If the rezoning and permits take longer than anticipated, the project will be delayed and the developer won't be able to pay the additional interest until the project is complete. This will also affect the timing of any marketing campaigns which are subject to rezoning, and consequently the construction will also be delayed. Other factors that can jeopardize the outcome of the project are higher inflation and higher interest rates, which would cause the real estate market to slow down, and of course sales would slow down as well. As we mentioned earlier, high-risk investments yield higher returns. Due to the risks that were just mentioned, development projects typically pay investors 8% per year with a deferred lender's fee based on the profits of the project, or a higher annual return with no deferred lender's fee at exit. If time does happen to be an issue, interest will accrue until the exit but will not be compounded. So now let's take a similar look at syndicated mortgage investments in farmlands. In this case, your client's investment is either used to acquire more land or to purchase new equipment and infrastructure. In both cases, the investment is used to make the farmer's operation more efficient in order to increase their bottom line or profits. So what's the risk here? Well, in this case, an interest reserve is not needed as the interest is paid from the farm operator's income. In the event that the farmer cannot make the scheduled interest payments, we reserve the right to repossess the land for a power of sale in the same way that the bank would execute a power of sale on your house had you not made your mortgage payments on time. Therefore, the main risk with this investment is lower future farmland values, which based on recent trends and the future outlook for population growth, demand for food, and many other factors, lower future farmland values seem very unlikely. Going back to risk versus return, we can see that farmland investments do not depend on factors such as consultants, rezoning, and permits, and also that interest is paid from an income-generating business, thus making the risk much lower than in real estate development. Consequently, the return is also lower, typically being around 3% per year, with a deferred lender's fee equivalent to 40% of the increase in farmland values across Canada, as reported by Farm Credit Canada, Canada's official farm value reporting agency. If you would like to watch their Spring 2013 Farmland Values Report video, please follow the link below. So now you have two different flavors to offer your clients. For the aggressive investor seeking higher returns, you can offer a syndicated mortgage in real estate development, and for the more conservative investors, you can offer a syndicated mortgage in farmlands. Or, of course, a combination of the two to balance your client's portfolio. Thanks again for your time. If you would like to attend one of our full presentations or learn more about our company, please email us at info@networkfund.ca or explore our website at www.networkfund.ca.